Thank you.
Thank you so much, Andrew. Thank you, Ryan, for inviting me. I've seen some friends here in the audience. I've also attended various seminars in the series. They're just wonderful. I'm honored to be here. So this is a very new project. We're changing the title even as Angry Borrowers. So this is joint work with Li Liao, Zheng Wei from Tsinghua University. Cong Yi graduated from Tsinghua and joined Alibaba. So this data is not from Alibaba. I want to make that clear. Hong Jun is from DePaul University, and he is here in the audience. So what do we look at? We're talking about angry borrowers, right? That's a consumer lending market. But before I tell you the whole story, let me ask you a question. Do you prefer to receive $20 or $0? You say, what? Of course, I prefer $20. Here, let me give you a little bit more context. Suppose two people are dividing $100. The proposer say, hey, you take $20, I keep $80. And if you say yes, you will have this $20. The proposer keeps $80. If you say no, then both of you will get nothing. It turned out this so-called one-shot automated bargaining experiment has been conducted over many years and in many different countries. And the outcomes are very much similar. If the proposer gives less than $20, usually the recipient will say no. So essentially, you choose 0 over $20. So here, there's a word from psychology, it's called negative reciprocity. And interpretation is, in response to hostile actions, people are frequently much nastier or even brutal, of course, at their own peril. So this is not at their best interest, at least not financially. So there are many experimental evidence in different areas of economics, such as wage bargaining incentives, public good provision, social norm formation, and so on. So we are, to our best knowledge, the first try to examine negative reciprocity in the real financial market. So here is our context. We're looking at the cash loan market in China. So cash loans are very similar. The cash loans in China are very similar to the small dollar loans in the US. These are uncollateralized loans, and they're very small in terms of amount, provided to subprime borrowers, and the term is usually within 1 year. So this business started in 2012 in China and grew very quickly after 2014. As of the end of 2017, there were more than 30 million borrowers aggregating over $14 billion in terms of the loan amount. So that's a pretty big and growing market. So what's more about this market? Default rates are very high. Typically, actually, most of the time, much greater than 10%. So debt collection is critical, right? So unfortunately, there are not many tools available to these cash loan lenders. First of all, there are no collaterals and no guarantees. Secondly, the loans are very small. On average, in our sample, this is around $250. So litigation is literally not feasible based on economic value. And to make matters worse, in China, the public credit registry under the central bank, they had very limited coverage of individuals. They have pretty good coverage of businesses, but not individuals. And also they don't even include performance of cash loans because these lenders are not financial institutions. These are, almost all of them are high-tech companies. So these are not in the banking system, and the central bank does not report these loan performance. So essentially lenders cannot use credit report or credit rating to discipline borrowers either. So what do? Typically, they rely on heavy text messaging and calling borrowers, sometimes using maybe nasty languages, but that's pretty much it before October 2015. And there's weak punishment or penalty for default, and collection were ineffective. So that's the context before October 2015. So in October 2015, there was some ingenious and creative collection mechanism, we call that intrusive collection technique. I'm going to make that clear why it's intrusive. So essentially, these lenders are going to call the social context of delinquent borrowers. So delinquency is defined as if you have outstanding loan, you didn't pay in full amount within 3 days of the due date. So if that's more than 3 days, it's called delinquent. So the lender is going to call the social context from your phone book. Actually, I'm going to give you more context how they get it, to inform your social context about your delinquency and ask them to urge you to repay. These calls are typically very short. There's a script, and these collection agents are supposed to follow the script very closely. There are two goals. The main one is to improve repayment incentive ex ante, because the threat of social shaming and anticipation of social sanction can make some borrowers to repay. Because if you don't, once your social circles are informed about such default, or not default yet, delinquency, you might be inferred as a bad planner, overspender. So if you go beyond your capacity, or a bad person, if you have the capability to repay, but you're unwilling to repay, you're a bad person. In either case, your social images will be damaged in your social circle. And that is important in China, because in China, the informal, we call that 关系 society, or it's the connections, your social capital and social reputation is quite important. So that's the main goal. And in some cases, especially if the borrowers are very young, the context of, in many cases, their parents may even volunteer to pay on behalf of these borrowers. So that's the setting and the motivation of this collection tactic. And here is the main results that we find. We were interested in knowing how do these collections work exposed, right? So given the threat, some borrowers may be motivated to repay, but actually to make that threat viable, literally call the borrowers who do not repay, right? So after you call the social circles of those delinquent borrowers, how would that affect the repayment? Or if you flip the coin, the default behavior of these delinquent borrowers? We find actually the collection tactic increases default propensity by 10 to 25%, depending on the specification. And the results are quite robust to different approaches, including propensity score matching approach. And we're attributing this to negative reciprocity. So essentially, you are retaliating if you believe this treatment is unfair, and you want to feel good by doing something damaging to the person who did the bad thing to you first. And the retaliation intensity would depend on a few things. The first one, we call that grumpiness. The literature showed that male individuals tend to be a little bit more strong in terms of negatively retaliating the proposers or whoever offending them. So that's one thing we're looking at. We find our results are mainly concentrated in male borrowers. And that's also depending on your capacity to retaliate, right? Retaliation is not for free. If you default, at least you sever the tie to this platform. You won't get any financing in the future from this particular platform. So if you are more able to afford severing the tie, you may be able to do this, right? So we're looking at credit ratings that we find is the borrowers who have a higher credit rating, they're more likely to default. They're more able to retaliate. And we're also finding people who would disclose their Taobao account, as I'm going to get more details, voluntarily. So those are the ones tend to have higher credit quality. They tend to default more strongly after these collection calls. So we have some alternative hypotheses I'm going to address. I'm listing 2 here. So later I'm going to get there. So I think this is probably a good point, Andre, to look at some of the questions. Thank you.
Yes. So this is a very interesting setting, I think new to a lot of our participants. So I would like to understand more about what's going on here. So how do lenders raise money? Where do they get the money to lend to the borrowers?
So that's a very critical point. For the time period we're looking at from October 2019 2015 to March 2017, that's the time lenders mainly getting money from other investors, for example, other peer-to-peer lending platform or other wealthy individual investors. They are not working with financial institutions yet. Current days, they get money from financial institutions. That changed the landscape quite a bit. So these are money from other investors, from other tech companies.
Are there legal limitations related to these disclosures?
It's a great question. So I consulted lawyers in China as well. This action was legal. Not only the platforms did this, actually the court system relied on social shaming to enforce repayment. So if the court give the order for some people to repay whomever they owe money to, and they just don't do that, the court could just post on the bullet board in the large railway station with their name and personal information for a week just to enforce the payment. It sounds very weird. In China, the privacy definition is very narrow. It's more involved with some private issues, for example, sexual orientation, maybe medical condition, or exposure of some body parts involuntarily. So it's legal. It was banned. The practice was banned in December 2017. That's after our sample period, because of negative effect or the negative sentiment. So I'm going to get there. There were some high-profile cases involve suicide of college students. So that's when the tides start to change.
So how do they know about the social contacts, and are these borrowers active on social media? And just to follow up on that particular question, because this kind of be related, is there a selection issue that
yes.
lenders go to social contacts only when direct interaction fails to deliver the results?
Absolutely.
Then it could be the more difficult to recover than average loans.
Yes, these are all critical questions. Give me one slide. I'm going to get to how the lender get the social contact information, and the selection issue a little bit later than that. The selection issue is a huge deal. We want to identify the treatment, which is the collection call. But actually the selection is working there. So we have to be clever in terms of how to design our sample. So these both are very critical questions. So I am postponing both of them for a slide. After this slide, I'm going to get there.
Okay. Are there, okay, so hold on. Are lenders able to garnish wages of borrowers?
No, not these lenders, not even the court back to that time.
Okay. Can there be substitutability between the platform and the social networks?
That gets to some alternative hypothesis. For example, can you borrow from parents rather than from the platforms? And a more specific point is, can you borrow from your parents to repay the loans from the platform? I think both are possible. If you can borrow from your parents, many people would probably do that because the interest rates here are extremely high. Actually, the platform didn't share the interest rate with us, but we know very safely this is 3 digits in terms of percentage points. Whether your parents may help you to repay some of the loans, we know in some cases that's true, but that's probably a fraction of the cases, not all.
Okay, so let's see what's the context is, and then maybe there will be a few more questions.
Sure. Let me go through the literature really quickly. Just one slide. I'm going to give you the loan application procedure and how the lender gets the information. So we're kind of at intersection of 3 literature strands. One is reciprocity. I already talked a little bit about that. So those were experimental evidence. So we're using the financial market data to look at this. Privacy is the big literature. It turned out that literature focused on the trade-off between information sharing and privacy protection. And a lot of discussions about whether the information disclosure is done without fully informed consent. So here I quote one sentence from the paper by Acquisti, so I'm probably butchering the name. So I'm going to read that because this describes precisely what we're facing in our context. Consumers are often in a position of imperfect or asymmetric information regarding when their data is collected, for what purpose and with what consequence. So I'm going to get there on the next slide. So that's exactly because these lenders, these borrowers did authorize the disclosure of delinquency, but they didn't know how that authorization is going to work against them in the future. There's a new literature in the debt collection studies, and that's about the social incentives. How could you use social shaming? So that is, if you don't repay, then that's going to damage your social images among the people that you care about, so your family, your friends, your coworkers. There are two working papers, both are working at the ex ante effect. For many people, that's the more natural angle, right? So if the lender say, hey, if you don't repay within 24 hours, I'm going to call, the people you care the most from your phone book, then many people may repay within 24 hours. So that's exactly what they find. So Brusa et al. And Diep, Nguyen, they both look at ex ante effects. If you send a reminder or if you let the borrower know there is such possibility, none of them reinforce this calling or contacting the social contact. Both papers didn't do that. They just look at after that reminder, what happens, and that does reduce the default rate. Actually, the second paper look at both the delinquency and default. The first paper is looking at default after delinquency. So that's about the ex ante effect. We're different from those two papers. We're looking at exposed. If these delinquent borrowers do not repay, what would happen after you call their social contacts? So here is the application procedure. So in order to apply for a cash loan, first of all, you have to install an app. And in this process, borrowers have to authorize the lender to access their phone, mobile phone information. So essentially you give them the account and the passcode of the account. This is a precondition for loan application, and you're going to be stopped right there if you are not unwilling to share this information. So as a result, the lender can crawl all the information from your phone, including your contact numbers, text messages, and call records. So essentially the lender has access to a lot of information, and you are asked to give permission explicitly to the disclosure of delinquency if it happens to the third parties. The language is very weak. It's almost just like that. I'm translating that word by word. So you give the permission to the lender to disclose delinquency to the third parties. So you don't know about the timing, you don't know the exact approach. How will this lender disclose delinquency to which third parties? Those are not spelled out. So you do know you authorize this, but when those calls really happened and you learn about this, there's quite some surprising factor, at least in the first half of our sample. So that's the first step. And then you register for opening account. So you have to disclose your national ID. This is very similar to a social security number. Provide bank information for fund transfer, your mobile phone number, and also the lender can access to your past borrowing history, at least from that platform, your criminal records, your bills, and they may purchase some other data from the third parties. And applicants may get the loan approved. If that's approved, that's going to be a credit line, and applicants can withdraw the line, the money from the credit line immediately, so within seconds. So that's essentially the procedure, and you repay the loan in monthly installments with interest, principal, and fees. The borrowers are also encouraged to disclose some other information voluntarily, for example, your social media account. And one piece we do look into more carefully is your payment and purchase record on Taobao. Taobao is the largest online retail market website, actually, that's in the world. It's representing over 80% of the online retail in China, so it's kind of important. And about 80% of the borrowers, they do voluntarily disclose their Taobao account information. And we believe these borrowers want to let the lender know that they are good borrowers. Perhaps their Taobao record contains some signal better than otherwise they look like in terms of credit quality. Debt collections, I'm going to go one more slide before I go to more details. So how does this procedure works, right? So before the due date, there are going to be reminders sent to the borrowers to say, hey, your 1,000 yuan is due in 3 days. Please repay on time. And here's the link. And there are going to be reminders passed to immediately through both text messages and calls to the borrowers themselves. And if you don't repay, so there's 3 days grace period. There are going to be reminders, again, in the first 3 days about the upcoming social shaming. If you don't repay, the social shaming, which are the phone calls to your most frequently called people on your phone book. And at the end of the 3rd day, if the loan is still not repaid, you're going to be entered as a borrower. You're going to be entered a list of collection. So at the beginning of the 4th day in the morning, so that list is going to be distributed to the collection agents. They have the borrower's information, their contact information. So they're going to call the social contacts, the key contacts of these borrowers to inform them about delinquency and to urge them to help with the collection and payment. On average, they call 77% of these delinquent borrowers, not 100%. So I'm going to stop right here. Andrew?
Okay, yes. So again, lots of questions. So
All right.
I have questions. So what happens if the borrower is mistakenly identified as being delinquent? Is there any recourse against the lender?
So mistakenly means you've repaid, but your social contacts are still called.
For example, again, the company has whatever technical issue, technical error, in which identified some as borrower. Any way to mitigate this, social shaming? Did it ever happen? I assume
I think that's possible because, for example, you may pay at 8:30 a.m. On the 4th day, but you enter the list at the end of the 3rd day. So maybe you got a call right after you repay. That is a possibility. I don't think that's the majority. I don't think there is a remedy for that. At least I don't think the platform has the incentive to call or recall their calls to the social contacts to say, hey, this guy already repaid. I haven't heard about anecdotes on that.
Okay. Another selection issue is that may restrict the external validity of the findings. Not everyone would agree to let lenders access to their phone books.
All these borrowers, yes, I think that's a great question. All these borrowers in our sample, they have to allow that, otherwise they won't get the loan. So to what extent we can generalize these results, I think that's the external validity issue. So to what extent these borrowers are representative to borrowers in other market or in other countries, I think that's a critical question. That's also very important. So let me give you 2 anecdotes. One is actually in the US, they, for sure they cannot call your social contacts, right? But the delinquent borrowers, you cannot get away easily, right? So you have credit rating. And actually, many of the lenders also sent these delinquent borrowers to the court, right? So the court would give you the final verdict, whether you have to pay this amount or that amount. So that also can backfire. So in the paper, we mentioned one case for JP Morgan Chase. So because for JP Morgan Chase, if you say, I'm going to send you to the court, if you don't repay by this day, they have to do that. They cannot send 77% of these delinquent borrowers to the court. They have to send 100%. And they're making some other mistakes in the process. So that creates a very negative reputation for them, and they suffer a lot. So that's one case. Another one you're probably more familiar with is the foreclosure in the mortgage market, right? So if these borrowers cannot repay their loans, or maybe it's underwater by too much, the bank can get the property back. But we do know some of the borrowers sabotage their properties. So that's kind of in a similar spirit that we have, in the same spirit that we have here.
Okay. Does the lender proceed with social shaming systematically or selectively? For example, only shaming borrowers with well-known parents, or kind of identifying some, social contacts which are more likely to be, stepping in and paying for the delinquent borrower?
So I'm going to get there. Usually they don't. They look at the phone book. Say on average, these borrowers have more than 200 people on their phone books. And the lenders sort by how frequently and how long you talk to the people on your phone book. So they tend to start with the top 5. Say, but actually most of the time they only talk to one of them. So for 97% of these collection calls, you only talk to one of the social contacts. For 3%, you talk to more than one. So you talk to the one you believe to be the most important one, and that would do it. That could be parent, if you talk to your parents all the time. That can be your boyfriend or girlfriend, or that can be your coworker if your boss talks to you all the time. So they don't really target particularly. Actually, they could if you really want to do that, but there's no clear way to label which one is a rich parent, which one is your boss.
Okay. Reaching out to borrowers' data might help the lender target new potential borrowers from the borrower's connections. So it might be the overall propensity to default increased, the number and amount of collections might be increasing. Is social shaming pushing the connections to repay more quickly?
I'm not sure I got this question. The first half I got very excited. I thought this is a brilliant question. So are you suggesting here we're using calling the contacts as a way to acquire new borrowers?
I think there are actually 2 questions perhaps in one,
Yeah,
but so,
yeah.
okay, so let's focus on, does allowing access to borrower's contact increase the ability to lend, increase the number of borrowers?
I think for that, you don't have to call these social contacts. You'll have their phone numbers to start with. So calling them, telling them about their friends or their sons or daughters not paying back may not help you to attract that potential borrowers. So you have those phone numbers to start with, right? So you can use those to acquire as the tool to target your potential clients in the future. So I don't think that's the first order purpose of these calls.
Okay. There were reports in the press about score system in some of Chinese provinces. Can defaulters be afraid of such a system?
There are many scoring systems in China. The official one is the Public Credit Registry, which is under People's Bank of China. That's the central bank. It was built based on business, and that's only related to financial institutions. For example, if you have a credit through a bank, or if you have a mortgage loan through a bank, you are in that system. So that system covers about 25 to 30% of the population around our time. So it's limited coverage. And it's been talking a lot, say, for alternative scoring. For example, Alibaba has the Sesame score because Alibaba has Taobao, Tmall, and that covers a lot more population, at least double the size of the public credit registry. And Alibaba mostly rely on your Taobao, Tmall purchase and repayment report. They also include other information. And the third one is for each platform. Say, for example, our lender, they have their own database. They have their own credit rating system and the credit ratings for these borrowers. So usually these lenders treat their information on borrowers as their intellectual property, their assets, because singling out these bad borrowers are costly and they're unwilling to share the list with other lenders. At least during our sample time, they're unwilling to do that. There should be more recent development is to consolidate the data in the fintech market. I don't think that's in place yet. It was not there, definitely was not there during our sample period, which is 2015 through 2017.
Okay. When you say that the exposed delinquency rate increases, what delinquency rates do you compare? For example, do you look at borrowers who have ever experienced social shaming after delinquency? What restrictions do they impose on borrowers with delinquency history?
So let me give you a little bit more detail before I give a complete answer to that question. The short answer is, if you delinquent on the platform once, you're done with it. The platform is not going to lend you any money anymore, period, that's it. But you can possibly go to other platforms if you have good credit rating. But I'm going to tell you more about the measurement. Just bear with me for a few slides.
Okay. Let's go then.
All right, cool. So because there are many delinquent borrowers and these collection agents, they don't call everyone. So if you look, so I'm arbitrarily divide the universe into two sub-universe, and this is 77% of the universe. That's we call that collected. The handwriting is not good. So these are the loans. Collected means the borrower's social contact was called by the collection agents, and 23% of them are uncollected. Right. So, but you cannot directly compare these two halves of samples because the platform does not call them randomly, right? They don't call like, they draw a coin and to say we call these 77%, not those 23%. The platform has an algorithm. So essentially, they're trying to sort the delinquent borrowers based on the predicted repayment propensity. And they tend to prioritize the collection effort among the borrowers who are more likely to repay. So this is exactly what the platform told us. And we verify this in terms of borrower characteristics and in terms of the default rate. Because if you call these borrowers, especially if you sort these borrowers from the most likely to repay to the least likely to repay and put them on a gigantic list, these collection agents are more likely to start with the most likely to repay borrowers because their compensations are a fraction of the collected amounts. So they have no incentive to deviate. So if you directly compare the two universes, then your conclusion is going to be the opposite. Because the ones you collected, they are more likely to repay in the first place. The default rate is actually much lower than the ones you didn't bother to call, right? So that's the 38% versus 59%. So that goes back to the earlier question. The selection plays a big role because the platform prioritize collecting the more likely to repay loans. So that gives you a lower default rate for the collected loans. So what do we want to do? We want to find a subset of collected loans as well as a subset of uncollected loans if they're very similar in terms of characteristics, right? So if those two are the last few, if you work throughout the day, the last few you called, you work through those and you say, hey, I'm tired, I'm going to stop because these agents have flexible work hours. And these are the fews you didn't call, but you would have called them if you work for another 1 hour. So this is going to be more comparable in terms of loan characteristics, borrower characteristics, and repayment propensity, right? So essentially there's no selection anymore. So these stopping, we call that stopping point, is probably depending on agent's choice. So to give you more details, on any given day, there are around 200 collection agents. These are internal collection agents. They are within the company. It can be fewer, it can be more, depending on the agent's work schedule. And each morning they get the list, right? So essentially collector A will get the list of the borrower and then with their contacts phone numbers. And the agent A may work from 9 a.m. to 3 p.m. And when the agent stopped, number 29 will be the last one he collected, and number 30 is the first one he didn't collect. So we are trying, ideally, we want to identify the last few the agent called with the first few the agent barely missed for all of them, right? For each of them, because the sequence is given by the platform, sorted by the predicted default probability or repayment probability. Unfortunately, we have 200 of them, and we have the call time, the timestamp of all those calls, but we don't have the agent's ID. So they're all mixed together. We don't know who make those calls. So if one agent worked from 9 to 3, then the call made from 2 to 3 p.m. are going to be the last few, right? But if another agent start from 4 p.m. and works till 11 p.m., then 10 to 11 p.m. will be the last few the agent call. So we don't have a clear or definitive identification of which loans are the last few calls or which loans would be the first few calls had the agent worked a little bit longer. So we are going to rely on the average, which is in general, if you aggregate these 200 collection agents, the loans collected early during the day should be on average more likely to be repaid than the loans collected later during the day. So let me show you a few characteristics of these loans and borrowers. So the first one is, these are new borrowers. For these default studies, is general, almost universal. New borrowers are more likely to default. They have less at stake. They don't have reputation here. And probably some of those are frauders. You never know, right? So usually new borrowers are more likely to default. So the very last point is the ones you didn't collect. And then we sort the collection calls from 9 a.m. to 22, whatever. So this is 10 p.m. or later. So 8 to 9, there's only one call, and 11 to 12 p.m., there are only 6 calls. So essentially we lump that 1 a.m. call to the one call during 8 a.m. to the 9 a.m. So 9 a.m. captures all the calls happen from 9:00 to 9:59. And the last one, 22, is 10 p.m. after during that day. So you can see in general, there is an increasing trend of new borrowers. So there are more and more new borrowers. And actually from 4 p.m. Going onward, you see almost a monotone. In this case, it is a monotonically increasing trend. And these are the ones you didn't call, right? So on average, this one falls between the 21 hour and the 22nd hour. So this is not the only one property. If you look at the credit ratings, credit rating is letter grade from A to F, and we convert that into numerical numbers. 1 is the best, and 6 is the worst. So there are not many changes early on, but at least from 8 p.m. onwards, you see a very substantial worsening in terms of the credit quality. Again, these are the ones that was not called. So this is somewhere, again, between the 9 p.m. and 10 p.m. hours. And this is the fraction of the payment that you've already made relative to the long term. Say this is a 12-month equal installment loan. You already paid 9 relative to another person who only made 1 payment. You have a lot more at stake, and you're very unlikely to default on loan, given that you already repaid 9 payments already. So for this, we see a generally decreasing trend. So in the later hours, you see a smaller ratio of repayment over terms. The last one I'm going to show you is default. So again, you see in general, there's increasing trend. The calls you made early on during the day is going to be a lot less likely to default. This is conditional on delinquency, how likely the loan is going to be default. So in the morning hours, 9 to noon, the default rate is somewhere between 30 and 40%. And if you go to 10 p.m. hours, this is already 60%. Again, these are the ones you didn't call. So given this trend, we have 2 identification strategies. The first one, the first one is very transparent. We just use a cutoff time. So we started with, so we keep all the collect calls after 4 p.m. and we keep every single uncollected calls because we have 23% uncollected calls. We have 77% collected calls. Using 4 p.m. is conservative after I show you all the graphs, and also using 4 p.m. gives us relatively balanced samples. We have about 700 collected loans and 700 uncollected loans. And later I'm going to show you if we narrow the bandwidth of collected loans, our results become stronger, almost monotonically. And our second approach is a propensity score matching approach. The first one is simple and transparent, but the first one we include every single uncollected loans, right? So those loans are not equal. So in the second approach, we match uncollected loans with collected loans based on the predicted propensity to default. So those propensity scores were determined by the loan and borrower characteristics. By using a propensity score matching approach, we can select on both sides, both the collected loans and uncollected loans, to make a more fair comparison. So this way, we can get rid of most part of the selection effect and focusing on the treatment effect, which captures what do the calls do to borrowers' repayment behavior. So I'm going to focus mostly on the first approach. The second one, propensity score matching approach, gives very similar results if there's any stronger results. So the first one is just transparent. So I'm going to show you more of that.
Okay, before we go there,
Right,
let's get a few more questions
go
answered.
ahead.
So, do borrowers face the same borrowing rates or they vary with some score?
The rates vary with their credit scores. So there are 6 credit score categories. There are 10 interest rate categories. I think they are highly correlated.
Okay. What information is used to measure borrowers' credit worthiness for the default propensity?
We don't have the model. Any platform, if you ask, they said this is their proprietary algorithm. So essentially, we use all the data we have. So for example, loan size, loan term, the interest rate level. We have these 10 discrete levels. We don't have the numbers because nobody is going to share you like 300%, right? We have how many payments you already made, the payment relative to term fraction. We know whether you're new borrowers to this platform, your gender, age, whether you are from a large city, and whether you disclose your Taobao account, and how many phone contacts you have. So these are the ones we just put all of them in as our prediction model.
Are you able to control for difference in quality of collecting agents, or is it not relevant for your test?
Well, we wish we can do many more things. I think the top on the list, I want to know who made those calls, right? If I know who made those calls, I can clearly identify which ones are the last few calls or which one are the first few missed calls. I think that's the one thing I really like to have. We won't have that. In terms of the collection quality, I think there is highly possible the agents have different abilities in collection. We just don't have any, we don't have the data to do any cross-sectional tests based on agents because we're averaging them. So we can say at least on average, how does this do? One thing is the agents have to follow the script very closely. They cannot be nasty and they cannot talk forever because that's not in their best interest either, right? So that's kind of, in that case, they're kind of uniform.
Okay, why borrowers pick up the phone? I think in more general is what can we tell about these phone calls? How long do they last? You know, are there a lot of drop calls or 2-3 seconds calls? You know, and generally
Yes.
speaking, why would people accept the calls from someone they don't know?
That's a good question. People learn not to take calls that I don't know. These are real calls. You might have called 5 people on the list and you reach number 5. You talk to the person for maybe 1 or 2 minutes, you stop. My colleagues, my co-authors in China, they got a few calls, probably more than a few. And one of them trying to get more out of the calls, trying to extend the talk time. The collection agent were not willing to do that because they have the more important things to do. They want to call more people. Whether that's a conversation or not, the system has the timestamps. Essentially, whether the other side is picking it up, right? If it's only a ringing tone, nobody pick it up, it's not counted as you contacted the person.
Okay, does the list of borrowers not called by an agent get passed on to the next agent?
That's a good question. In theory, they can do that. Say, so you're talking about the borrower level, right?
Yes, yes.
Okay. So the 77%, in our data, 77% of these borrowers' contacts are reached, 23 are not reached. That doesn't mean all the 23% are the worst ones. In general, they are worse. I show you the trend. It could be some of them you just cannot reach their contacts, right? That could be well in that pool. That's kind of a noise to our test. But if you didn't reach the borrower today on your list, would you try to go back to them the next day? Usually they don't. So we did have that conversation with the platform because every day there's a fresh list and that list you cannot even handle. So if you missed it, you missed it. We do see calls occurred on the 5th day. So 97% of the calls occurred on the 4th day, 1.5% occur on the 5th day. That can be due to an agent who is absent, maybe due to sickness, maybe due to family emergency. So that person may use the same list when he or she comes back to work the next day. But usually they don't revisit the old list, even though in theory they could.
Okay, again, probably this question has been already answered, but are names on any calling list randomly selected and randomly ordered?
There is no advantage to randomly select them. After they read our paper, maybe they see some advantage, right? So they have this list, they have the order, and they believe this order help them with the collection. So the agents would have very strong incentive to follow the order. If you make 30 calls during a day, would you like to target the ones that the platform told you they're more likely to repay and you're going to get 3% of the money or more? Or you would just random call. I think agents have very low incentive, small incentive to deviate. Of course, they may miss some of the social contacts, maybe all the 500 contacts from one borrower, they decide not to take a phone call, and that borrower would fall into the category of uncollected ones. I think from agents' perspective, there's no strong incentive to deviate, to do the random calls. They don't know who the calls are. Occasionally they call the journalist or a person who works for the police department. They may get themselves into trouble.
Okay, thank you.
All right, thanks. So let me show you the data really quickly. This is the summary statistics. Default rate, condition on delinquency. So all the ones we're talking about are delinquency ones. So this is 3,000 out of 7,000. So essentially we start with 7,100. 40, a little bit more than 40% of them are delinquent. If you look at the default upon delinquency, that's at 43%, is very high. A default is defined as 60 days past the due date, you still haven't paid. So after that, very, very, very rarely the borrower is going to repay. So that's the industry standard 2 months in China. So we just follow that standard. That's also used by banks. 77% of these borrowers are collected, so their social contacts were reached. Loan size is small. If you convert the average, you divide this one by 7, that's renminbi, that's around $250. Term is under 1 year, so median average are both around 6 months. And interest level, there are 10 categories. We don't know the interest rate, but I know this is 3 in terms of percentage points. And payments, this is at this point, on average, they have made 2 payments out of 6 because the term is 6 months. And payment relative to term, so that's the average, 43%. A lot of new borrowers, 65% over the entire period, a little bit much less in the second half of our period. Male, mostly 80%. This is the case for this market for both peer-to-peer lending. I have other papers looking at other peer-to-peer lending platforms. Even in the US, it's still vast majority, typically at 3/4 male borrowers. And this one is 80%. Age, average, mean, both are 26. We have a quarter of them under age 22, 22 included. 46% of them are from large cities. We call them tier 1 and tier 2 cities. These are very large cities with population more than 8 million people. So that's essentially large ones. 79% of them volunteered their Taobao account information. So you can see a lot. You can see their purchases and their payment. On average, they have 248 contact persons on their mobile phone. The median number is 187. To show you the main results, this is when we use the full sample and use 4 p.m. as the cutoff point. So I have 2 pages. I'm going to show you the second page as well. So essentially, this is a probing model. The dependent variable is default, and we're looking at this dummy collect, and we see a positive significant coefficient estimate. If you see other things, large loans are more likely to default, longer terms are more likely to default. If you have paid several payments already, you're less likely to default. Not much loading on interest. Older ones, again, these are all young people, but among them, older ones are more likely to default. Borrowers from large cities are less likely to default. The more contact persons you have, you're more likely to default. Economically, this is corresponding to 5.8 percentage points. So to give you the context, what does that mean? 5.9 percentage point for these uncollected loans, the unconditional or the average default rate is 59%. It's very high, right? Because these are the ones you don't even bother to call in the first place. So if you use this one, the other one is the collected ones, the average default rate is 38%. So if you want to be conservative to say, well, suppose the base is 59%, making the call would increase the default by 5.9 percentage points. So this is our 10% increase estimate. And on this page, I show you for the ones who disclose a Taobao account voluntarily, they're less likely to default. And for credit ratings, A through F, A is the baseline. So you see a monotonically increasing trend, except F, there's a little bit dip. The worst credit rating borrowers are more likely to default. So we have month fixed effect in this estimation. And this is to show you if we narrow the beam width of the collected loans, right? So the main specification, we use 4 p.m. That gives us 700 uncollected loans and 700 collected loans. So if we push this cutoff point to a later time of the day, we're going to have smaller and smaller sample for the collected loans. That means our standard error is going to increase gradually, but that also gives us the loans in the collected sample that is more similar to the uncollected loans because they're the ones with worse credit quality and less likely to repay. That's essentially what we find. From 4 p.m. to 6 p.m., we don't see much change. And from 7 p.m. onward, you see a substantial increase. These are the margin effect. So if you call, if you look at the calls after 7 p.m., calling would result in an increase of default rate of 9.9%. If you look at the last hour, actually this is the last 2 hours because there are not many in the last hour, there's going to be an increase of 14.3 basis points. Percentage points. So that's a substantial increase, even given the baseline of 59%. Question, Andre, or should I go forward with more slides?
Okay, again, coming back to the external validity issue, it seems that most borrowers are young males, which is not surprising given that these borrowers may be at early stages of their social capital formation and thus more willing to risk their reputation by letting lenders use their social contacts. Is this worrying?
So that's about this external validity. So I can say so whenever I've also conducted field experiment. For a field experiment, you would face that challenge even more, right? Because you can only have one field experiment with a special context. So that's always a challenge. To what extent this is representative, I can say very safely, this platform represents really well the cash loan market in China, because this is one of the largest players. It's still in the market today. I also know the peer-to-peer lending market. I have several papers looking at the peer-to-peer lending market in China. I also look at Prosperous Lending Club. That's the US data. That's also peer-to-peer lending market. So in that case, this is not that unique, both in gender distribution and in age distributions. They are very similar, surprisingly.
Okay, I was wondering how to interpret collect coefficient. Do you include all loans that are not delinquent?
No, these are all the loans that are delinquent and did not, that's the short answer. So these are all the loans who didn't pay after 3 days. They got onto the list and 77% of them are called, 23% are not called. So collect is one for the 77%, of which the social context was reached by the phone calls, and the 23% wasn't reached are the ones coded as 0.
Okay. Do you have any explanations on why interest rate does not affect the default?
I think it's probably captured. So by, for example, so this is a good question. I've asked myself about the same question as well. So the interest rate, usually a higher interest should indicate maybe this should be more likely to default, but higher interest rate can be correlated. I don't have the correlation table. Maybe I should have that. Higher interest rate are usually correlated with the loan size as well, and also with the credit rating. So remember, now we're putting in everything, right? Credit rating has a very high explanatory power. So you may expect credit ratings do not load while the interest rate should load. Another thing is interest rate. This is not the actual interest rate because the lender is not willing to share the interest rate with us. So we have the levels. We have 10 levels. I think some of the variations may be captured by the credit rating, and some may be due to the sign is correct. We don't have the power. Some may be due to we don't really have the precise interest rate.
Okay. Curious if there's an effect coming from the time of the call. People usually are more emotional in late night and thus make bad decisions.
That's entirely possible, especially if you call the mom and the mom is probably 70 years old. I think that's entirely possible. If you have anything in mind, you may make those calls. The calls you think that's hopeless anyway in those later hours. We're not trying to rule that out. That can be part of the story.
Okay, thank you.
All right, thanks. So I've shown this to you. So far, I'm trying to tell a negative reciprocity story. So essentially, if the lender does something bad to you, you want to be nasty and retaliate. And this has a condition. Given that you authorize this disclosure in the first place, why should you get anger in the first place, right? Why should you feel betrayed? So we're going to look at several dimensions. The first one is whether there is a suppressing factor, because the tactic was adopted in October 2015. And for the first year also, this practice has been there, but people were not fully aware of it. So maybe there is a shock to you when you realize, hey, actually the platform is using my permission to do this. That's bad. So I'm going to feel good. I'm going to retaliate. But if you already become fully aware of this, if you take out the loan later during the sample period, maybe you shouldn't react so strongly. So that's kind of the sub-period study, and we find exactly that. And we also look at the gender difference, how male and female borrowers respond differently. And we also look at the capacity to retaliate. The first one is the context. So we are dividing our sample, it's pretty small sample, 18 months, into two halves because the new technique started in 2015, October, and it became gradually more popular. But this practice was pretty much hushed. Nobody tried to advertise that broadly. And till the summer of 2016, more precisely in June 2016, the media, excuse me, uncovered several really high profile and controversial cases involving some borrower suicide because they feel like there's no way they can escape the traps, and their disclosures of collection techniques, some are worse than what we see here. And regulators started looking into the practice and tightening their monitoring. And actually they banned, this is not exactly our research, they banned the campus loan. These are the loans, cash loans for students, college students in August 2016. So the general sentiment has changed in the middle of our sample, which is the summer of 2016. And people, the borrowers who took out their cash loans after August 2016, most likely, if not all of them, fully aware of the social shaming consequence of delinquency. So it's unlikely when they learn about these collection calls, they're going to be completely shocked and say, hey, I didn't know you could have done this to me. Now you do this, I'm going to retaliate. So the shocking or suppressing factor is going to be less. So as a result, we expect weaker to non-results, to little results in the second half of our sample. So here we're dividing our period, 18 months into the first half is from October 2015 to August 2016, inclusive on both sides. We see the effect is in terms of coefficient twice as large, and in terms of economic magnitude. So the collection is linked to 10.6 percentage point more delinquency. And in the second half, when the borrowers are probably aware of such practice and they probably shouldn't react so strongly, we find no results. We have the same control variables. So that's the first results. This is consistent with our predictions. And we have the tables in the paper, but I'm going to present the cross-sectional results using the figures. So here we're giving the marginal effect. So for example, this is about gender, right? We are looking at male borrowers and female borrowers separately. Collection, if you look at the point estimate, has some effect on female borrowers, but there's no statistical significance at all. It's not we don't have enough female borrower. We do have enough, but there's no significance. Depending on how you specify, how you cut the sample, this can be negative in terms of the point estimate. For male borrowers, there's a very substantial effect. So now we're going back to the original specification. So this is after 4 p.m. You see somewhere around 13% of effect linked to the collection. So male borrowers after receive the collection calls are 13 percentage points more likely to default. And the difference between the two is also statistically significant, even though it's marginal, it's at 10%. Go ahead.
Okay, let me ask a couple of questions. So I guess once a borrower contacts have been called, the borrower figures that the damage has been done, so they retaliate. The question is, would they have repaid if their contacts had not been called?
Yeah, that's a great question. And that's also the question we have in our mind. So there are several alternative explanations. This is the most important one because people tend to focus on the ex ante effect, right? The threat of social sanction or the threat of social shaming would force some borrowers to repay in the first place. Now you already called my social context. What else I would lose? So that's kind of, it is our result, just the mirror image of the ex ante results. So we have a few points about this. First of all, I think that effect exists. It must have played a role there, right? So we're not trying to rule it out. It has a role because at least one of their social contact you care was reached. In 3% of the cases, 2 of the contacts are reached. So there is a lift or reduction in terms of the anticipation effect. But this cannot be the entire story. So we have 2 points about this. First of all, you have 248 contacts to start with, right? And one of them was reached. In theory, the lender can reach many more of them, and the lender can call the same person repeatedly. That same person, which is most important to you, so they can still call. There's still social shaming anticipation there. So it's not kind of that threat is eliminated, but it can be reduced. So we agree with that. And secondly, we have a results which help us with distinguishing the directional prediction. So here's the gender result. So imagine you are thinking 100% of the results are coming from the lift of anticipated social sanction, right? So if that's the case, then for female borrowers, which are documented in many studies, both field experiments and surveys, females tend to value privacy more than male. So suppose you are a female because you value your privacy more. So that anticipation effect would work more heavily on you. In other words, if you lift that anticipation effect, you would expect to see a substantial more increase in terms of the default rate among female borrowers because they care about social reputation, they care about social sanction. So you leave that effect, then they should react very strongly. That means you should observe more default among female borrowers. We don't see any of that at all. What we see is more default in male borrowers. And this is consistent with our negative reciprocity hypothesis because males in surveys and in some experiments tend to show less prosocial, or they tend to get grumpy more likely. So that this gender result helping us with the direction. If this is purely a lift of anticipation of sanctions, then we should observe stronger result among female borrowers. But that's definitely a great point. That's something we keep in our mind all the time.
Okay, are there many such online lending platforms? If so, what is the market share of this platform?
Nobody knew how many platforms like this. I have some anecdotes about slightly different platform, peer-to-peer lending platform. At the peak, there were 6,000 and it became 2,000. I think the equilibrium may be 200 or fewer very soon. The cash loan market is slightly different because the interest rate is much higher and the borrower's quality is probably much lower. So I don't know exactly how many. I think there could be in the hundreds or could be in at least several dozens. This is one of the major players in the market. We cannot say this one has 50% of the market, but this one is quite representative. It has substantial market share. And sometimes the media just expose their behavior as the bad apple.
Okay. What are the collection practices of the competitors? And I'm going to bundle this with another question. Do you
Yes.
observe the sex of the person calling?
I'm sorry, say it again.
Do you observe the sex of the person who is making the call? You know, the female collectors more successful
No.
than.
Remember, we don't even know who makes the call, right? We want to, if we know who makes the call, our identification would be cleaner than what we have, because all these 200 agents calls are lumped together. We don't have their IDs, so the platform didn't give us that.
Okay. So about collection practices of our competitors.
Very, very, very widely is almost the norm back at that time. As I told you, even the court system used that, and the court system did even worse. They post your personal information on the billboard in the railway station and the very busy cross intersections. All people can see that.
All right, let me defer the remaining questions till the end of the seminar. So
right,
let's move on.
All right, so here is for the credit rating results. Credit rating A is the best credit rating and credit rating F is the worst. So again, I'm plotting this margin effect. So this bar shows you the average effect, this average effect, and this is 25th to 75th percentile range. Sorry, I didn't explain that earlier. So this is essentially 31 percentage point increase in default if you call the really good quality borrowers. Credit rating B, very similar, this slightly higher, is also 37%, 35. This one is insignificant. Credit rating D, you still have some 20% or so. So these are probably the good ones among the subprime borrowers. For credit F, if there's anything, we see the opposite side. Maybe your parents pay on your behalf. Maybe you feel like the borrowers may do something even worse, you repay. So essentially what I want to emphasize is this negative reciprocity, or you want to feel good behavior, is stronger among the better credit rating borrowers because they have other resources. They can go to a different platform. If they're willing to pay 100% interest rate, they can get loans almost immediately from a different platform. But that's not the case for credit rating F borrowers. And this is the last cross-sectional results I'm going to show you. This is the Taobao disclosure. So these are the 80% borrowers. They're voluntarily give you access to their Taobao account. You can see their purchase histories, their repayment history, and everything. So here we find if the person voluntarily share the Taobao account, the effect of collection on them is very strong. The average is about 25% percentage points, and the range is very high as well. So because these are the ones, everything else equal, the better quality borrowers, so they have the ability to retaliate, even though that's costly. For those who do not disclose Taobao account, again, this is the negative direction. So we don't see such retaliation. It could be other factors at play. And the difference between the two groups are substantially significant, statistically and economically. Propensity score, I'm going to show you two slides. Propensity score, we do match every single uncollected loans with collected loans. So we start with 1 to 4 match. We also try 1 to 3, 1 to 5. They're very similar in terms of results. We're able to match 214 uncollected loans with 432 collected loans. This is about 40% of the sample for both sides. And what we find is after matching, we use all these characteristics. They are very similar in all dimensions, except after you do the matching, the collected loans are going to default with 56% probability, and uncollected ones are 37% 39%, the difference is 17%. We also use this subsample to run a regression, and we found a very strong loading, and this is about 12 percentage points. So if you, this is similar, right? So one loan versus another, they're very similar. One you call, another one you don't call. So this gives you a 12 percentage point difference in terms of default probability. I already explained this. This is the last one I'm going to cover. There's another alternative hypothesis, even though my audience haven't raised that yet. It could be, right, these borrowers have some liquidity shock, a negative liquidity shock, and that make them unable to repay. And perhaps calling the parents or their friends would damage their reputation already, so they cannot borrow from their friends to repay the loan. So that would create some liquidity constraint on these collected borrowers. So what we do is we don't have a perfect empirical strategy on this. Our second best is to use their consumption pattern, and more specifically is for the 80% of borrowers who disclose their Taobao account, we look at their consumption levels on Taobao. So what we find is the red line is about uncollected loans and the green line is the collected ones. They mimic each other really well. So 0 is the time when the loan went to delinquency. We look at 2 months before and many months before that. That's the base. We'll look at 1 month, 2 months, 3 months after the delinquency. We see in general there's a decreasing trend in consumption. That could be consistent with liquidity constraint on the borrower side, but we don't see substantial difference after the collection call between the red line, which is uncollected ones, and the green one, which are the collected ones. We don't see statistically collection damage their consumption. So even though their consumption level goes down relative to the time well before this episode, so we don't see, at least from the data we have, we don't observe that collection incrementally reduce their consumption level on Taobao. To conclude, I know my co-author Hongjun has a survey at the end. So Andre is going to post a link there. To conclude, what we have done here is, to our best knowledge, we are the first empirical study to look into negative reciprocity in a real financial market. And we're looking at this privacy infringe debt collection tactic, which is to target the social circles of delinquent borrowers. What we find is there are more defaults, especially among male borrowers and borrowers with high credit quality, so they're in a better position to retaliate. And this is not merely driven by the lift of anticipation effect, and we don't find a clear evidence of liquidity constraint. So we have a caveat. The caveat is saying we're not claiming these platforms are dumb in doing these collection calls because they have to. If we want to see anything in terms of ex-ante effect, they have to call some people exposed. How many should they call? Should they call 77% or 23%? Whom should they call? And overall, what's the net effect on their profitability? Net of the money they pay the collection agents, that's unclear. But the anecdotal evidence, again, that's in our footnote of JP Morgan Chase case, suggests this might not be a good strategy, especially if you have alternatives. In US, you may have, say, credit rating or other things. If you have better alternatives, you may not want to do this. Thank you.
June, thank you. We have a few more questions, and I
Sure.
would also ask the participants to stay a minute after this presentation to listen to Hongjun Yang's announcement. All right, so a few more questions.
Yes.
So do we know the male-female ratios of the cities where the borrowers live? Wei and Zhang 2011 argued that agents display different saving behavior in the regions with imbalanced sex ratios, thinking of their sons' marriage prospects. Shaming might be strong in such places.
Yes, that's precisely what we find. We find that, well, actually, that's not what we're, so it's a little bit more complicated than that. So you're, big cities, right? So you're talking about in big cities, do you see more female or male borrowers in big cities? How do they respond to collection tactics differently? So there are several layers. First of all, is in big cities, you probably have more alternative sources to go to, even though they're online, but you may have access, or maybe you know more of the resources. So if you damage one of them, you may be able to easily acquire another one. So that's one thing. Another thing is in big cities, people may care their privacy differently from people living in the rural areas. So there are several layers. In the end, in which way the big city pan out, we do find some results. People in the big cities tend to react more strongly, actually. I don't know whether that's a direct answer to your question, but I will be happy to hear more if you have more to follow up on that.
Okay. Are you able to differentiate between parents and friends being called?
We cannot. That's one thing I wanted to do. I want to link these numbers to the phone books. It turned out there's no way we can link them. We cannot tell who are parents, who are friends, but we know their calling times on the phone book, then we can have some inference. We just don't have that connection. It cannot be done.
Okay.
Wish we could.
Social shaming, is it still a valuable collection tool on the net?
We're not concluding on that. That's essentially my caveat. It may be valuable if you do it right. But from our experience here, and even using some data from Brusa et al., that's the work, one of the two working papers, by putting them together, if you consider anything you pay for the collection agents, I don't think it's the profitable thing to do, even in China.
All right, Jun, thank you very, very much. We're going to give a minute to Hongjun Yan to make an announcement.
Sure.
And then also next week, please join us for Ben Iverson's presentation. Ben Iverson from BYU. He's going to talk about, well, let me see what he's going to talk about it. Okay,
Thanks
I'm
a
going
lot,
to tell you in a
everybody.
second. Yes. Hongjun Yan, why don't you go ahead?
Thank you.
Great, thank you so much. First of all, thank you for including our paper here, and thanks a lot for the questions, and thank you so much for staying behind. Currently, we are running a survey, and we are really trying everything we can to increase the sample size. I'm now sending you the message with the link for the survey. It takes about 3 to 5 minutes to finish. The survey asks your expectations, risk attitude, political leaning, those kind of things. It's all obviously anonymized. No personal information will ever be collected. And I'm going to also post another message which include my social media post. Now I really regret I didn't try to grow my social media in the past. Now it's really the time I'm hoping to get more exposure. It would be great if you can share the post on LinkedIn or Twitter post. I'm sharing you in the chat box 2 links. One is to the LinkedIn post, one is for the Twitter post. It'd be great if you can share it with your student, with your friend, or social media. Hopefully we can increase the sample size from there. And I'll be more than happy to share with any of you if you're interested in knowing what we are finding. So this is really the final stage of our survey. I really appreciate your attention. Thank you so much.
All right, thank you everyone again. So Ben Iverson next week is running up the tab, personal bankruptcy, moral hazard, and shadow debt. So that's next week, but this week, again, thanks June a lot for this very, very interesting presentation. Tons of questions. There are some questions unanswered, but June is going to receive the chat, and she is going to reach out to you if she finds, that it's relevant.
Andre, can I stay a few minutes late so anybody can sign out? I will stay a few minutes longer if I have further questions you want to discuss. Just unmute yourself. Thanks.